Good evening, CEO and founder of
Recording in progress.
Essential Trading Academy. I really want to say thank you for the privilege, to be here. And thank you everybody for making our time to be here also. It's not easy, truth. Everybody's busy. And you all had ones, and some persons here might be working or something like that. And you are here, all right? Please, if you can hear me clearly, just drop some ones on the chat box to be sure that my mic is clear. And also, if the music in the background is too loud, drop some tutus. All right, so I'm going to reduce it. It won't disturb you guys, okay? But is the music too loud? Somebody can confirm for me. In the background instrumental. Hope it's not too loud. All right, thank you. So, thank you for having me here, and thank you all for making our time to be here. And should I be also saying thank you for choosing to learn this skill? Okay. I know that much of the time I've been taking tonight, into technical issues here and there. But trust me when I say that at the end of this class, you will not regret being here. Okay? And I've known Essential for a time or for some time now. And he's consistent. All right, he's consistent. So being under him, being in this environment is a good place to be. All right. So thank you so much also, Essential CEO, for having me here again. I don't take it for granted. I was asked to speak on smart money concept. All right. Like he said, smart money concept is one of the leading concepts out there in the forex society. Now, I would like to make some things. Hope you have your notes, anyways. But I would like to give some announcements or make some things very clear. Is that it's for the sake of my head, for the sake of the head of Essential Academy and his team, that whatever you are seeing here, all right, or whatever we're teaching you here, first of all, for educational purposes, all right. They are also for entertainment. So if you feel entertained, laugh where necessary, and enjoy the class. But it's for education and for entertainment. I'm not licensed to give a financial advice, so we are just here to learn about the financial market. I'm not licensed to give a financial advice, so don't. We're not giving out trade calls here. But just know that this is just for this, okay? So tomorrow somebody will not say I learned from him, and then it's possible. I've seen somebody do it. They sue you for financial advice. If you get to court, you pay for that, okay? So just know that this class is strictly for educational purposes and entertainment. But then I'm going to be teaching about smart money concept, introduction to smart money concept. Now, it's not only the concept and approach to trading forex markets out there. This concept is not the only approach to trading forex markets. There are millions and different kinds of approaches. So some persons have found their own system. All right. But one of the things you realize is that no matter how much anybody system, no matter kind of system anybody's trading, you always realize that in one way or the other, they have smart money concept have something to do there. Either in form of liquidity, because liquidity, when you hear the word liquidity, it's under smart money concept. Either in form of institutional reference points, order blocks, mitigation candle, SMCQ, imbalances, IPA, FVG, all those words are all under smart money concept, all right? And I'm going to give credit to the founder of smart money concept, and that is ICT, all right? Is it Michael Hodinson or something like that, all right? ICT, some of you must have heard of ICT here and there, all right? I'm not teaching you ICT concept, but he helped a lot. So smart money concept was coined from several of all those things, all right? But let's leave the history of why smart money concept was called smart money concept. But just know that smart money concept is a good concept to learn. And also, I would like you to know that there is no concept out there that is 100%. There is no holy grail out there. There is no holy grail out there. One of the fastest ways to avoid running in cycles if you're learning something is to choose something and learn it and just choose to stick with it. Don't complicate the information. Don't join this bootcamp to want to gather information, and you join on that bootcamp on that way to gather more information and look for a way to mix every single thing up to come up with how you will confuse yourself. And I'm telling you the truth, you're going to pay for it. All right. So this concept is simply straightforward. And I'm going to be guiding you on how the concept, or what we look at in this concept, what the concept is usually made of, or how it functions, and how we can use it. Okay, so let's dive right into this. So what is SMC about? Smart money concept. Smart money concept is simply a type of strategy employed in technical analysis in the forex market. Now, there are three types of analysis in the forex market. All right, there is the technical analysis, which has to do with the charts. You're just looking at charts, past price data to predict future price data. That's what technical analysis is all about. All right, so you open your chart, you're looking at the past price actions to look at or to predict what the future price action wants to do. Fundamental analysis has to listen to interest rates. You are following interest rate policies, CBN policies, or not CBN now, central bank policies of different currencies, like the Central Bank of America, Central Bank of England, all those central banks in different countries, all right, the Australian Central Bank, and so on and so forth. All right, so you guys have to do with fundamental analysis. Some persons call it news trading. All right, you focus on listening to the news to be able to predict the strengths and weakness. Trading forex has to do with trading two pairs, the strength and weakness. If AUD is stronger than USD, you want to buy AUD USD. If USD is stronger than AUD, you want to sell AUD USD. All those kind of concepts. So some persons just use fundamental analysis to try to predict what price wants to do, and all that. All right. Then you have sentimental analysis. Sentimental analysis, just as the name is, it has to do with trying to focus on what the big guys are doing and roll in line with them. So if the big guys are buying, you want to buy. If the big guys are selling, you want to sell. Some of the tools you can use are the commitment of traders report. Those things are very advanced. Okay, commitment of traders reports, interest rate differentials, risk on risk off concepts, and so on. All those things are very much advanced and not needed at this particular stage. Okay, so but then what is SMC? SMC is a type of strategy employed in technical analysis. Emphasis on that. All right, no doubt we have some part of we have a role of sentimental and a role of fundamental analysis in that. But SMC is employed in technical analysis in forex market. The aim of SMC is to make us able or become able to trade like the institutions and the banks. All right. In forex, you never want to trade against structure trends. All right. You always want to follow the trends and you always want to follow structure. Just a minute. So in SMC, in forex, you never want to trade against structure. You must have heard that if the structure is bullish. Yesterday we learned about market structure, bullish market structure, bearish market structure. So if the market is buying, you don't want to be selling. If the market is selling, you don't want to be buying. If the market is bullish, you want to buy. If the market is bearish, you want to sell. You never want to trade against the trend of structure. Another thing again, you don't want to ever trade against the banks. The banks plays a major role. Now, several persons have different beliefs as to why price action move the way they move. Some believe in demand and supply, which is okay. So if you're here and you read economics, the simple concept of demand and supply, all right, that if the price of a thing or the demand of a particular good or stock is higher than the supply, what is going to happen? You're going to see the price do what? Increase, all right? Many persons are demanding, they want to buy toothpaste, but then there is not enough toothpaste. What will happen to the toothpaste stock in the market? The prices will very much increase. Those that have money can buy, all right? But if the supply is more than the demand, what will happen? The price will crash. Some persons believe, okay, based on this, that is what the market moves, or that is how the market moves. Some other persons believe on different or trend line that just draws lines in the charts, and then market will always bounce from those lines, and that is how they move. Some others believe in support and resistance. But in smart money concepts, we don't believe in lines, trend lines. Those things, and please, those concepts are correct, all right? They are not wrong, they're not bad. Like I said, there are people that trade virtually other concepts out there and are profitable. But for you to be here, you're here to learn smart money concepts, and we are to teach you smart money concepts. This is how we trade, this is how I trade, and it has proven to be profitable. If you feel this is not going to be it and you want to go out there, it's still all good, all right? I'm not saying that smart money concept is the best concept out there. Or the only concept, other concepts are useless. No, I don't deny their which word would I use now? I don't deny how good they are, because they work too for some people. So, but then if it is in smart money concepts. All right. If it's in smart money concept, we talk about how the banks trade. All right. We talk about how the banks trade. We don't believe in smart money concept. Why they are? We see trend lines as liquidities. We see support and resistance points, especially when it has to do with price levels. We see them as liquidity points also, right? So in smart money concept, we believe in what the banks are doing. We believe in the all grading. We believe in certain factors. All right, that the banks, this is what they want to do. They're pumping money, and why it's called smart money concept. Let me say again is the word first. Let us leave the money and the concept. Let me take them individually. You know what it means to be smart. You need to be smart in a world full of manipulations, in a world full of evil, in a world full of cheating, in a world full of several things. Okay, you just need to be smart. So, and then we now talk about money. You know what money is. All right, in the forex market, there are tons of manipulations in the market. Now, these manipulations are caused by the banks. They are caused by forceful, a lot of manipulations in the market that the banks can do, which we're going to talk about later on. A lot of manipulations in the market. So smart money concept is just simply an understanding of what these banks wants to do when they begin to pump in money into the market. When they begin to pump in money into the market, how do we position ourselves to maximize our opportunity? That is what smart money concept is. So why you don't want to trade against structure and trend, you also don't want to trade against the banks. It is very, very, very important to take note of that. Okay. Then, if you're with me to this point, kindly drop some ones on the chat box. If you are confused, you're lost, drop some sentences on the chat box. All right, let me show that you guys are following. If you're with me to this point, just drop some ones on the chat box. If you're lost or there's a confusion anywhere, kindly drop some sentences on the chat box. All right, thank you. So progressing from there, we said, why do we trade this way? Why do we trade smart money concept? Number one is we trade smart money concept. All right. Sorry. All right. We trade smart money concept because it gives us an edge as to what the banks wants to do and move, and gives us the ability to move, all right, in line with them. Please, just a minute.
Guys, I hope you all are with your pen and paper. Like, you need to take note of every word of coach. It is very important. Please make sure you are with your pen, you are with your paper. Make sure you are noting everything. Thank you.
All right. So can you hear me now?
Yes, we can. Yes, we can. So sorry
All
about
right. No problem. It's all good. All right. So, as saying, why we trade this way, it gives us an edge as to what the banks wants to do in the forex market and then move in line with them. Number two, these banks manage large funds, which give them the power to become able to manipulate the forex market. So SMC help us to trade in line with them. Now, we want to understand that in the banks, when you Google the top 10 banks or forex institutions in the world, you realize that there's something about the banks. Is that these banks, over $7 trillion circulate in the forex market every single day. $7 trillion circulate in the forex market every single day. And out of this $7 trillion, there are certain banks like the JP Morgan Bank and Citibank and big banks that makes huge percent of that every single day because of the kind of money they pump into the market. All right? Because of the kind of money they pump into the market. And now let me show you something before we come back to this. All right? I will show you just a minute. I will show you before we come back into the SMC checklist and why we want to use them that way. So just a moment. Let's get our browser. All right. So let's look at this word, scooping. The Morgan scooping case. Just a moment. All right. So let's look at what scooping is all about. I hope they defined it here for us. All right. JP Morgan is one of the, I think, the highest bank or forex trading institution in the world. The highest, because they make the largest share out of the market. They make the largest share out of the forex market. Remember, in the crypto market, I think about $600 million circulates every single day in the crypto market. In the forex market, we have about $7 trillion that circulate every single day in the forex market. All right. So now you see that the former JP Morgan traders convicted of fraud, attempted price manipulation, and spoofing. Sorry, not scooping. I spelled it right. Spoofing in a multi-year market manipulation scheme. Now, when you go, what spoofing means is just manipulations, all right? Spoofing means manipulations. When you read this story, you realize that one of the things that JP Morgan do is they know that they have the liquidity, all right? The evidence, look at this now. Look at this. Let's read this. You see, the evidence at the trial showed that between approximately May 2028 and August, so the defendants, along with other traders on the JP Morgan precious metal desk, engaged in a widespread spoofing, market manipulation and fraud scheme. You know, it's quite funny how the defendants, let's continue reading. The defendants placed orders. Look at it. The defendants placed orders that they intended to cancel before execution in order to drive prices on orders they intended to execute on the opposite side of the market. The defendants engage in thousands of deceptive trading schemes for gold, silver, like those of you that like trading gold, and several other stuffs, including the forex market. You know, some persons that trade demand and supply and all those things said it's not possible for manipulations to ever happen, and they don't know how the forex works. That is just the truth. This is the case, for example, you have here. Now, the defendant, which is JP Morgan, all right, you can see this case now they had, and many other cases with other banks, this spoofing case that have come up before. You realize that the banks, one of the things the banks do is that they want to place an order when the banks wants to buy. In short, long story cut short, is that you realize that when the banks wants to buy, first of the things they do is to sell before they buy. The aim of selling is to take out all the positions of people that are intending to buy with them, or people that are actually seeing those buys before they eventually buy. All right. And if they want to sell, they first of all trigger some kind of, or open a fake position, push price to the upside, lead people to buy with them, only for them to take them out. That's exactly what the banks do. So you see them, these defendants, all right, look out here. The defendants place orders they intended to cancel. So they will place a buy order, move the price to the upside for a particular period of time. People will see that the price is moving all the way up. They intend to buy the price. They intend to buy that particular asset together with them, because these guys have the liquidity to move the market. They have the money to move the market. You join them in the buy, only for them to place orders that they intend to cancel, all right, before executing in order to drive prices they intend to execute. So they place this order, they know they want to cancel the buy order because their original order is sell. But they will first of all place a buy order. Everybody will join them in the buy, then they close their buy orders and begin to sell and take your stop loss is their money. Because one of the things in the forex market is that as you are making losses, those losses you're making, somebody else is making it as a profit. When you make profit, your profit is somebody else's losses. That is how it works in the forex market. Your profit is somebody else's losses, your losses is somebody else's profit. So because it is money that is circulating, we are trading money in this financial market. All right. So an understanding of this is going to guide you on how to trade. That is why we trade the smart money concept. We work with the banks. Now the question is, how will you now know when the banks wants to do this? How will you know how? We'll talk about that later on. All right, as we progress, we'll talk about that. But this is what smart money concept is all about. All right, this is what. So you can see they've engaged in thousands of deceptive trading sequence for so on and so forth and all that. So if you want to read more on that, on the spoofing case of other big banks, you can all right, look that up personally and continue from there. Okay, so we'll come back to that. Let's get back to what we are looking at over here. All right, so why we trade this way? Just a minute. All right. Oh, sorry. So why we trade this way? So like I said, it gives us an edge as to what the banks wants to do so as to move in line with them. These banks manage large funds which give them the power to become able to manipulate the forex market. So SMC helps us to trade in line with them. SMC helps us to trade in line with them. Now, like I said, note, there is no strategy that is the holy grail as to deliver a 100% result. The fact that you're learning SMC does not mean you will not blow account. If you're a beginner, you don't have to, there are certain indices that makes a trader profitable. It is not just the concept to trade. The concept is one of those tools, but not the only tool. In short, it's even the least of the tools to become profitable. All right, psychology and risk management is the major thing that makes you become profitable, not even the strategy you trade. All right, the strategy, get a proven strategy, you are good to go. Work on your psychology and risk management, and then you are okay. All right, so but now note, there is no strategy that is a holy grail as to deliver a 100% result. There are many strategies out there. Nevertheless, SMC, like we are learning here, is a proven strategy which has existed, which has been used by so many great traders that ever existed. All right, so SMC checklist. Now, I'm leaving all those other deep, bigger stories of SMC, why the banks do and all those things. So now bring it down into the technical aspect and how you can maximize these informations. Below are the checklists we consider when trading SMC. It is very important to follow the order when analyzing the forex market. It's very important to follow this order. Now, whenever you want to analyze the market, there are a few things we want to take note of. All right. Number one, top-down analysis. Because now this is one thing about the banks, that no matter how much the banks wants to manipulate, the bank's manipulation can never change the trend. You get, the banks don't set the trend. That's another thing I would like it to. This is where some of the arguments that these other guys coming from can make sense. The banks don't set the trends. What sets the trends are fundamental analysis. If Central Bank of America comes out and increase interest rates and is not favorable to both the nation and it's weakening the currency, that means those news, those informations, those policies are going to affect the trend of the market. So the banks don't set the trend, but they have the capital to manipulate the trend just for a little while, but they don't set the trend. So hence the reason for our first checklist: top-down analysis, structure, and trend. Before you say you want to trade SMC strategy, you want to understand top-down analysis, you want to understand structure, you want to understand trend. Once you can align yourself with the trend, that okay, the trend is bullish, the trend is bearish, or the trend is ranging. Once you can define this, you will now know how to now be able to program yourself. Okay, overall the trend is bearish. Even if the banks wants to manipulate, after manipulating just for a little while, they are going to still sell. All right, so you want to first of all determine this trend. The next thing you want to determine is the trading range. The trading range is going to save you a lot. What is trading range? We're going to look at that. The next thing you want to understand is liquidity. Liquidity just simply means money. All right, since the banks are pumping too much liquidity into the market to make certain decisions of or what they want to do in the market, you need to understand the concept of liquidity. Banks, institutional candle, mitigation, IPA. Now, what this simply means is, when we say banks, we mean where they are hiding. Now, whenever the banks manipulate the market or make a move, they always leave what we call a footprint in the chart. They're always going to leave that footprint in the chart. So your ability to spot out those footprints will guide you on how to enter together with the banks. So maybe the banks wants to buy, they're going to leave you a particular kind of footprint that will make you able to see that footprint and join the bank in the desired direction they want to go, because they will always trade in line with trend, but they will manipulate before trading in line with trend. So having identified those banks, you will save yourself from a lot of stress. You will know when the banks is about to manipulate and know the right points to enter to join the banks in the original intended trend. All right. Then the last thing is fibs. So now let's go. Further analysis. This has to do with identifying the trend of the first checklist. Now is what we're looking at. Okay. Further analysis. This has to do with identifying the trend of the market, considering what the higher time frame is saying, because the higher time frame controls the lower time frame. A good knowledge and understanding of what the structure is saying will go a long way to help you determine if we're looking for buying opportunities or if we're looking for selling opportunities. What is trading range? When looking for opportunities, we also want to consider the trading range, which is made up of the most recent high and low points formed in a structure. This is what a trading range is. A trading range is just simply the most recent high and lows formed in a structure. For example, this is a trading range. You can see the low range and high range. At this very beginning, the first low, the distance between this low and this high is a trading range. So if you want to take a trade, you want to look for the trade within this low and this high. And this blue dot here will be your execution to buy, because price is bullish. Another low range, high range, you wait for retracement. Nothing concerns us with the range before now. We are only interested in this most recent lows and highs to get our position to go. That is an example of bullish, and this is an example of bearish. Sorry, I'm going to be a little bit fast. All right, so it's getting late, so I don't take much of your time. The smart money concept obviously is not something you learn in one day. I'm sure Essential Academy is going to put you through where necessary, and they're going to guide you on how to go about everything. Okay. Then the next concept is liquidity. Liquidity is simply where people's money are. Your inability to identify liquidity will eventually make you liquidity to the forex market. There's a popular quote that my mentor will say: if you cannot identify liquidity, you will become the liquidity. If you can not identify where those stops or where those banks are going to manipulate or where price is going to capture, you eventually will become, your stop loss will eventually become the point where they're going to capture. So your ability to spot those places will save you a lot. Banks, institutional candles, this is a very big topic on its own. If we should begin to dissect this topic, it's going to take us a lot of time, all right, to understand the footprints of the banks. But I will quickly touch it, but then for more understanding, we'll look at that later on. Okay. Then we have fibs. This helps us to identify discount and premium zones in the market so as to help us make a better trading decision. Now let us look at liquidity and banks quickly. Let's look at this. All right, so liquidity, let's look at liquidity. Liquidity, what is liquidity, types of liquidity, identifying liquidity, and rules for playing liquidity. Remember, if you cannot identify liquidity in the market, you will eventually become liquidity to the market. There are three types of liquidity. I told you that liquidity simply means money. Now, take note, price is always seeking to do two things. The forex market is always seeking to do two things. Whether you are trading in demand and supply or whatever you think, is always seeking to do two things. And that two things is price is always seeking to grab liquidity, is always looking to grab liquidity, and is always looking to rebalance price action. These are the only two aims of price, and that is my belief. So if price is always looking to capture liquidity or grab liquidity, your ability to identify where that liquidity is that they want to capture will save you a lot. So what you now have to do is to trade in line with that. Another thing again that price always looking to do is to rebalance price action. All right. So now there are 3 or 4 major types of liquidity. We have the external liquidity, internal liquidity, static liquidity, and dynamic liquidity. I know I'm a bit fast at this particular point, but the video will be made available in the YouTube channel, so you can always rewatch. Okay, please, because of time, I wouldn't want to keep you here for long. So let's look at external liquidity. These are liquidity that you find at the top and the bottom of your trading range. You know, for example, in a bullish market structure, you have price forming lows, highs, higher lows, and higher highs, right? You have price forming the lows, the highs, higher lows, and what? The higher highs. So you see, At every top, at the top and at the bottom of every range, there is what we call a liquidity there. There is always money there. How are there money? For example, when price was selling here, people sold here. People that sold here, where did they put their stop loss? They put their stop loss here, right? And they sold only for price to come here. If you did not take any profit here, your stop loss, where your money is, because you know you don't lose money to the market until your stop loss is taken. That side that your stop loss is where liquidity is. What did price come to? They took the stop loss out. So that is where money are. All right, so there is always money at the top and at the bottom of a range. In a bullish market structure, the price is always seeking to take the liquidity at the top of the range and leaving the one below the range. So you can see, when price is bullish, they don't really take the liquidity below the range. They're always aiming for that liquidity above the range. In a bearish market structure, it is the opposite. All right, price is always looking at taking the liquidity below the range and leaving the liquidity above the range. So, but any liquidity at the top and the bottom of every range, there is always liquidity. Internal liquidity in this other case, these are liquidities that are within a trading range. We're going to look at examples in the chart, okay? These are liquidities that appear within a trading range. They can appear in static or dynamic form. They can appear in a static or dynamic form. Now, for example, you have a low, a high, price will always come down. I think yesterday, the lecturer or the coach that taught you guys yesterday called it IDM. Price will take out an internal liquidity, grab that internal liquidity before they now start buying. So there is what we call internal liquidity. That is what we call internal liquidity. Static liquidity are just liquidity where you see equal highs to the upside, equal lows to the downside. Demand and supply level, people will say, okay, buy at demand or supply, or buy at support, resistance, support, resistance. But to us, what is happening here is liquidity is building up. How? Demand and supply level traders, yes, they will call here a strong support. So they are buying from here. Where would they put the SL? Right below here. TP above, right? Same things, resistant traders will be selling from here. SL will be here, up here. So you realize that in a static condition or in a ranging market, there are always stop loss below the support and stop losses above the resistance for people trading support and resistance. And what we price do usually either capture this to capture this, or they will sell or buy to sell. But we'll look at more examples on that also. Okay, so let's just run. All right, next is dynamic liquidity. Dynamic liquidity is trend line liquidity. You see those that trade trend line, the trend line is powerful, no doubt, I accept, because you can make money from here. You can actually make money from here. But to us, whenever we see this kind of thing, we are extremely careful, because what we follow suit is usually a very strong push to capture all those liquidity that you find there. So this is an example of dynamic liquidity. All right, that is an example of dynamic liquidity. So these are the types of liquidity. We'll come back to these rules of liquidity because we're not looking to take a trade now. We're just trying to understand the types of liquidity we have. Then lastly, what is the banks? These are the three major kind of footprints. Now, please, if you're with me to this point, drop some 1-1s. If you're lost, drop some 2-2s. I know some persons will be, it's going to get lost. If you're with me, drop some 1-1s in the chat box. If you're lost, drop some 2-2s. If your head is already hot, maybe I'm too fast, drop some 3-3s on the fire. I mean, on the chat box. All right. Sorry. I know it's lots of information, but then 3-3. All right, but then you can rewatch the video, like I said. And even if there's any confusion, you can also ask Essential Academy, and they will put you through. The team will put you through. Okay. And let's continue from there. All right. So I told you guys earlier that whenever the banks make a move in their manipulation, they usually leave a footprint. I'm not going to go in depth to start explaining how the footprints are formed, why they are formed, why are they even called those kind of footprints. So just permit me to jump and skip certain information to just go direct into this. These are the three major footprint candles I like to see, or footprints in the market. Number one is the mitigation candle, SMC cube, and IPA. We're going to go into the chart to look at these things now. A mitigation candle is a candle which captures liquidity before the main move. So like that spoofing case we saw now, the banks, we place, look at what is happening here. People are buying support and resistance here, but the banks will do what? They will place a sell order, so everybody will join them to sell. And you know, demand and supply, support turned resistance. So this was support before, now it has broken below. Why would they be seeing it as support turned resistance only for them to begin to sell, right? The banks will place heavy sell position here, and many persons will join them, be setting their SL. Some other persons will still join here, support turned resistance. They'll be setting their SL, only for them to now, their sell position is still on, only for them to now enter with a buy position, a heavier buy position. Let me take for example, they might enter 5 million lots on sell and push the price action down, and enter 10 million lots on buy and push the price up. You realize that now. So people that were selling at this particular point will eventually now enter a loss because of this buy. So the banks manipulated. So whenever the banks wants to buy, like I said here, whenever they want to buy, they will first of all sell to buy. Whenever the banks wants to sell, they will first of all do what? Buy to sell. So, but now look at the stuff behind this. Now is that whenever the banks now execute that their sell position, remember there's a sell they entered here to lead people on, only for them to now enter on that buy and start going. Now this their buying position will be in a profit, but their selling position is going to be in a loss. What mitigation now simply means is that these guys will usually come back into the place they entered that their sell position, close the trade out in a break even, all right, before they now eventually resume their original trade. That is what the banks do. So after they have manipulated, our duty is just to wait for them to come and retest, to close out that their original manipulated trade, to now join them in form of what you call mitigation. So price sold, captured liquidity, they bought, they retested, we enter from the retest because now they've given us that their footprint candle, and then we join them to buy. If the banks wants to sell, they will do what? They will buy first, capture liquidity, then sell, giving us that evidence that, oh, look at the banks came into this point. Then we look for what? Selling opportunities. So this is the bank footprint candle. Another example is your SMC cube, where you have consecutive candle and then only one opposite, maybe bullish candle, then one sell candle, bullish candle. Usually see price come into that region, test it, and then buy again. All right. Then lastly is your IPA, which is your, some people call it FVG, IPA, imbalance. All of them are the same thing, where you have a balance, something like this, 1, 2, 3 candle, but the first and the third candle, the wicks of those candle are not touching. So you now have them to, you know, you expect them to want to come into that point to retest before they buy. Let's go into the chart and let's study the chart. Okay, let's go into the chart and let's study the chart. I know many persons, a lot of things. You want to see this, you want to see that, you want to see this, you want to see that. All right, somebody should drop an asset in the chat box. We are going to go into the chat to look for something. Just drop any asset of your choice. This is good. Leave good alone. Just drop any other asset of your choice, and let's go into the chat and see examples there. All right, let's step index. All right, synthetic traders. Let's get to that. Let's get that is binary trading view, right? What about the king order block? All right, king order block is I really don't know anything much about the king order block. All right, I really don't know much about the king order block, all those things. I try my very best to keep these things very simple. All right, and many persons have, there are a million different terms called different things that are almost the same thing. All right, so, but I really don't know much about king order block. I just know about the order block, and it's good for me. All right, so that will just be it. All right, so the first person said step index, right? So step index. There's a lot of things I want to say concerning this step, concerning synthetic analysis. I don't know if I should say that or not. You know, some persons that trade synthetics think they're trading forex. No, they're not. You're not trading forex. If you trade synthetics, just yeah, I know it appears to be forex, but then it's just like a stock trader, somebody that trade local and foreign stocks, calling himself a forex trader. No, he trades stocks. Yeah, he trades stocks. Yeah, he's stocks trader. Forex simply means foreign exchange. It has to do with the exchange of two currencies. USD card, you're talking about the US dollar against the Canadian dollar. That is the forex pair. When you're trading step index, for example, step index and the USD card and all those forex pairs, gold is not a forex pair. Gold is classified under commodities. Gold is a commodity. US oil is a commodity. NASDAQ are indices. Forex are AUD, USD, GBP, USD, and so on and so forth. When we talk about indices, you are an indices trader. You're not a forex trader. If you trade jump, you're an indices. I know everybody calls it a forex trader, but that is not what forex is. All right, forex has to do with foreign exchange. Yeah, and the manipulations that happen here is quite much. So, but then it works well. The concept works here too. All right, the concept works here, but the banks don't. The concepts of smart money concept and banks doesn't really how will I say it now? The banks has no influence in synthetic analysis. Because if you realize there is no other broker in the world that offers step index and co except Deriv, and Deriv is just a broker. So they are the broker that created these indices to give you to trade. All right, they are the broker that created these indices to give you to trade. So any manipulations comes from the broker. But at the same time, you can use this thing there. This concept works anywhere. In anything that has chart, it works there. All right, so I just had to correct that. All right. So tomorrow, if you want to eventually delve into full forex trading, you know that you're delving into full forex trading. All right, so let's dive right into it. You know, I told you guys about ranges, market structure, and all those things, but let's first of all go into the aspect of looking out for those kind of candles. Let's go and look for those kind of candles, or what do they call this thing? The banks, institutional candle, imbalances, where price rejected from them in the past, and so on and so forth. All right. So see something here now. Like I said, I will not really be using the word the banks, because this is not the banks. CBN or JP Morgan Bank, Citibank has nothing to do with trading step index. All right. So all these things are derivative price action. But look at this kind of stuff now here. What do you have here? You have a structural point. Can you see? Liquidity was captured here. All right. Price was coming in the trend line right here. So some people were buying. This is a daily time frame move. This is not one minute. This is a daily time frame. So you can imagine how big that move was. So price was coming in the trend line. People were buying this touch trend line, and price gave them that kind of push all the way to the upside to capture that, only for them to now do what? Sell to the downside. Now they sold. Where was the mitigation? They came back exactly into that candle that captured liquidity. This was the candle, and they retested from there, and that was the move. Now look at this. Let me sorry. Let me remove this. Now look at this. A mitigation candle is just simply that candle that captures liquidity, like I said. Look at the liquidity they captured. Previous liquidity, they captured it, and then they broke structure. Look at that particular move that captured liquidity, that led to the capture of that liquidity. This was the whole of that move that led to the capture of that liquidity. Where did price come to retest? Exactly from that point. Okay. More examples. Look at this. Before we got the break of structure, there was some liquidity that was captured. There was some more liquidity that was captured. Price came down and finally broke. Look at what did they do? They first of all sold all the way to the downside, and they bought. And after that, what did you now see? Say my chart is not showing completely. All right. So after that, what did you now see? The whole of all this move that captured liquidity, from down, captured all the whole liquidity to the down here. All right. Where did price come back into? They came back all the way there, retested it, captured some liquidity. All right. Alexander, it's okay. I think we have a spammer now. Do anything and stuff like that.
Yeah,
and you should not Coach Tony will tell you that one of the things he said then to me that really he said that when scammers begin to locate you, when the scripture says the enemy comes to kill, to steal, and to destroy, all right, the thief will not go to a poor man's house. He always go to the people that have substance. That's the only way they can steal. You cannot steal from somebody that cannot have it, that don't have anything. You cannot kill somebody that is already dead. All right, to someone that have life and someone that have stuff that you steal. So I guess it's a proof and it's a sign that Essential Academy is something that is about to burst into a rising. All right, and the spammers will look for, spammers always look for, they make money from influencers, they make money from big names, and they deceive younger ones. So it's a proof and it's understanding that Essential Academy is about to break forth, is blowing and all this kind of stuff. So they are recognizing it. If they had not recognized you, that means you've not gone anywhere. That means your influence speak. All right. So those of you on the call here, don't be fooled by any of all those things you see. They are pained. All right. Just leave all those guys. They're very, very pained, and it's all of their business. So just chill and enjoy. They've taken much of the time again. Guys, their souls are blessed. Okay. Sincere apologies for the distraction and all that. Okay, so let's continue what we were saying. No cause for alarm. Life is not that hard. All right, so back to what I was saying. You have the banks. Look at this now. All right, this was the entire move that came to capture liquidity before they bought. So you can see the bank selling. Like I said, in synthetic indices, I cannot say the banks because the banks has nothing to do here. The banks has nothing to do in derivative. All right, derivative manipulations comes from derivative. Like if derivative themselves, they are the ones that manipulate the market as they want, and you cannot take them to court. Because if you read derivative license, you realize they have the ability to manipulate the market as much as they want, and you cannot take them to court. All right, because they control the markets they give to you. So you have to be careful about that. All right. So coming down, but then the concept works. Those footprints are there. Manipulations to sell to the downside, only for them to do what? Buy to the upside. Now, what did they came into? Capture internal liquidity and mitigated, and that was a trade all the way to the upside. Can you see that? Very clean. All right. And many more examples out there. I'm trying to look for more examples on imbalances and SMC cube and stuff like that. All right. Okay, now look at this. Look at on that one again here. You have series of liquidity captured, static liquidity. It's captured it. This was the entire move that came to capture that liquidity. The whole of all this candle, and where the price come into that same candle before they move down. All right. Many more examples now. Look at this here. This was several liquidities before price broke structure. The whole of the move that led to the capture of the liquidity. This was the candle that captured that liquidity, or the whole move. Where did price come into it? Exactly that move. And what happened? They sold all the way down. All right. And many more examples here. Look at this also. What do you have here? This liquidity that was captured here. This was the whole of this move that captured this liquidity. Where did price go to after breaking structure? Tapped right into that point, and they do what? Sold all the way to the downside. Now, these things can also be found on a lower time frame. But like I said, when you want to go to the chart to begin to analyze, all right, you don't go and first of all start looking for bands. You don't go and first of all start looking for where do you buy from, where do you sell from, and so on and so on. No. You must follow this order. All right, you must follow this order. You don't just go, you must follow the order of I think they are back again. We don't want you to rest though. Was it like this yesterday?
It was not like this actually. Who just joined?
Sorry about that. All right.
I've seen it.
You've seen it. All right. So like I was saying, you don't want to You don't want to just go into the chart and start looking for institutional reference, but you will kill yourself, because you will find that thing that you're looking for. If you go into the chart and you're looking for just banks, institutional candle, you will find it. But not all of them you will play. You have to remember that before you make a decision, you have to understand top-down analysis, structure, trend. All these things, we cannot go into them in this particular class. You cannot learn SMC in one day. It's not possible. All right. And by the way, the topic says introduction to SMC. So I'm introducing you guys to the topic. I believe somebody else will talk on liquidity, or maybe somebody will talk on fibs and entry pattern, psychology, and all those things. I can't teach everything here. I'm just introducing SMC to you. All right. And I think I will just have to leave it at that particular level. So for you to trade SMC, you have to understand top-down analysis, structure, and trend. You have to understand trading ranges, liquidity, banks, and fibs. And I've told you the 3 types of bank major move we are looking for. There are many more to it. It's not only these ones. There are many more. But these are the 3 I focus on because they prove to be highly respected in majority of the times compared to others. All right. So I'm going to leave it here. If anybody have questions so far, let's look at that. All right. I'm going to leave it here. I cannot begin to go into now to begin to talk about how to do top-down analysis, how to find liquidity, how to align yourself with time frames. Some of you that trade, sometimes you get lost in the path of daily time frame is bullish, but 5 minutes time frame is bearish, 1 hour time frame is bearish. This one is good. How to properly align yourself. That is a topic or treatment for some other day, of which the essential team are going to handle. All right, but this is an introduction to SMC concept. This is how we trade. This is why we trade the way we trade, and it is a proven strategy that you can learn. Trust it, stick to it, and it's going to benefit you. Okay. I don't know if there's any question. Please put the SMC checklist on the screen. All right, here's the SMC checklist. Sorry, just a moment. All right, this is SMC checklist. These are the processes. Like I said, you must follow them in the order. You must follow them in this order. Top-down analysis must be the first thing to do. When you want to conduct analysis using SMC strategy, the first thing after you open your chart is to do a top-down analysis from the higher time frame to the lower time frame. Align yourself properly. You can understand structural alignment and put yourself in that place. Then after that, the next thing you want to identify is your trading range. After identifying your structure and trading range, the next thing you want to identify is your liquidity. If your top-down analysis and structure and trend definition is wrong, every other thing that follows will be wrong. You will identify the wrong liquidity, the wrong trading range, the wrong banks, the wrong fibs, and you will eventually enter into losses. So you must take your time to do all these things step by step, so you can properly align yourself to make the right decision. So top-down analysis, structure, and trend, the first thing to do when you open your chart. Trading ranges is the second thing. Liquidity is the third thing. Then now identifying those banks is the fourth thing. Then finally fibs is the last thing. All right. That is it. You can watch the video. I wanted to say I will share the what are they calling it? These PowerPoints, but no need. You already have the video, okay? So you can watch it from there. So I guess this is where I'm going to stop it. Is there any other question before our host take over? All right. Okay. So no questions. All clear. So you can, I guess that's going to be it, essential. So Samuel, I think that's going to be it from my end for now. All right. So the law, and sorry, the reason I'm stopping here is to avoid the law of diminishing return, where you've learned too much, and you've not assimilated the ones you've learned, and you're still pouring in more information. Before you know it, you get confused, you get lost. Even the ones you know before we stop, you stop understanding it. So I don't want that law of diminishing return to happen. That is why it's better to just take it step by step, okay? So, but then this is the introduction to SMC, and I feel, I don't know, you tell me if I've done justice to that topic, and that'll be it, okay? So thank you for your time. Thank you for having me, Essential Academy. Thank you for having me, Mr. Samuel. I really do appreciate the time. Thank you all for staying even to this particular point. I really do appreciate you all. I don't take it for granted, all right? And I pray, I desire to see you guys at the top, all right? I desire to see you guys at the top. All right, don't quit on Forex. If you quit, now you do yourself. Don't quit on Forex. Don't quit on distance. And please just do me a favor before I leave the podium and drop some fire emojis for Sir Samuel. Just drop some fire emojis in the chat box to thank him for this gathering. All right, it is really powerful, and you know, to come up with this. And all that. It's beautiful. So just drop that fire emojis in honor to him. All right. I really do appreciate what you're doing, sir. God bless you and more grace, even as you run the academy. All right, so this is going to be it from my end. Don't quit Forex, just pay the price and learn. Tomorrow, the bootcamp continues. Make sure you're here on time, join on time, take notes when necessary, and ask questions. All right, so see you guys at the top. The Forex will pay you exactly what you want. All right, so thank you so much, Essential. I think that'll be it. I'm stopping to share my screen now.
Yeah, thank you, thank you so much, thank you so much, thank you so much.